Good evening, ladies and gentlemen. Welcome back to Walk the Block, where we are navigating digital finance all together. It is a very good day to be with you guys. We had a bit of a, American event that happened recently. Uh, wasn't really cheering for the Seahawks myself, but I live in Colorado long enough in the 2000s and 2010s to have Patriots PTSD, so kind of happy with the result. But that's not important. Anyways, tonight we're going to be talking about what the heck has been going on with the markets lately. If you caught last week's stream, well, then you kind of knew that we were setting up for something that could potentially be a lot of red candles. And, well, price went all the way down to 60K, but has actually recovered decently to about that 70K region. So we're going to be talking about what went on, what caused it, and is it all over? Are we so back? Somewhere in between? We got all that and more. But also, we have a bit of a fun story today. We're going to be talking about the PROVEX protocol, just giving a bit of an explainer and an introduction to the folks to the actual protocol itself, not just the sacrifice, because yes, that is well and done at this point, but now let's start talking software. Anyways, I'm your host for tonight, Zenith, and I'm joined by my excellent co-host as well, Tracker. How you doing, buddy?
Doing well. The only thing I'll bring up on the Super Bowl was when Seahawks were favored 3.5. I would have taken that all day. It was stacked. Actually, the game kind of played out exactly how I thought. If anything, I was more shocked at how well the Patriots defense was able to keep Seattle's offense in check. That was a little bit more surprising for me than anything. But as far as Seattle's defense, I was not surprised at all. They're one of the top 3 in the NFL. So anyhow,
there you go.
Pretty much laid out what it was. Anyhow, huh?
I can't remember what the final score was, but I think there's a good chance that the kicker is actually the guy who scored the most points in the game.
Mm-hmm. Yeah, he set a Super Bowl record. He had 5 field goals in the game.
Oh my God.
And Seattle's defense got a touchdown too. So I mean, there you go.
Oh yeah, they did.
And they had sacks. It's just they had like 6 sacks or something crazy. The defense was just the Patriots were mismatched. And now it goes back to everybody was complaining about how they had an easy schedule all year and everything like that. And then to add even more to that narrative, Denver's quarterback going down, not even able to play in the AFC. It's like, man, you got an easiest path in the world to the Super Bowl. And then, of course, Kansas City was out of there. Baltimore had a bad season. So all the big dogs that normally were there were out of there. Buffalo, they took care of Buffalo. So, I mean, all in all, hey, they made it there. They made it there with this 2-year quarterback. Their seasons are probably going to be good for a long time. They'll be there, but probably one of the easiest passes to the Super Bowl I've ever seen. But here's an error. But they still won the AFC
Super Bowl though,
huh?
Still got to the Super Bowl.
Oh yeah. They did the AFC champs, yeah, man. Well, and as far as I know, last week we were talking about it, and we were talking about going through key levels. We ripped through those. That was definitely a over exacerbated to the downside, in my personal opinion. We can go into those later. I was scooping up stuff on those exacerbated moves to the downside, maybe a day too early, things like that. But I was DCNA on those drops just because anytime you see something move that quick, you're going to get a snapback reaction at some point. And we'll talk about how much is that going to come to fruition or not. But these are opportunities when people are freaking out there. This is why you have a little bit of dry powder on the side. That's why you want to be injecting those opportunities, because people are not rational when those things happen. That's when you have clearance sale. Now, could you get more sales come? Sure, you absolutely could. But it's just proper DCA in, risk exposure, putting in good opportunities on these clearance sales. Just pepper those DCAs in. And as it goes up, go ahead and don't get greedy. Take some off, maybe short-term trades or long-term positioning to lower your DCA, things like that. So, yeah,
very big move, because we pretty much dropped all the way from like 74,000 down to 60,000 in the course of like 48 hours. And the emotionality is definitely one of the things we're going to be talking about tonight, because that is one of the indicators that hit by far the lowest. And yes, I'm talking about the fear and greed index. That one got all the way down into the low single digits, which is very, very rare. But yeah, look, there's more than one way to play this game. If you're a long-term person, you probably looked at this and said, good price, let's buy some. And if you're someone that, had options open, well, you were probably part of the giant liquidation that happened. So RIP to you. Sorry, bud, but that's how the game works. Yeah. All right, let's get into it, man. What's our first topic? Anyways, alrighty. So, tell you what, first one that we're talking about here tonight, we're going to be talking a little bit of PROVEX. So, PROVEX sacrifice, obviously over. So, now we're looking forward and waiting for the release of the actual software itself. Did get a little bit of a teaser. I believe a beta is open that was provided by Richard Hart. So, Again, if you're clicking any links, please go directly to the source. So in this case, go check out his Twitter. The link is in there. There are always scams and fake copies of this kind of stuff. So please be careful about that. But
Yeah.
yeah, Tracker, you had to give like the quick elevator pitch. What is ProveX and what's it trying to do?
Zenith, well, let me tell everybody a little backtrack what we're at. People that are in crypto that don't know anything about Pulse Chain or
Good stuff.
all this stuff. There's always been controversy around Richard Hart, like him or hate him. One thing you can definitely state in that area, the community is always pumping out solid products.
Stand by.
They have great products.
Tracker, I don't know if you can hear me, but your mic is pretty much cutting out. I'm getting like 2% volume out of you.
Oh, I'm sorry. How about now? Is it any better?
No.
Sorry, I apologize for this. Wasting everyone's time. Is that any better?
Yes, you're back.
Is that better? Yeah, okay.
You're back
sorry
there.
for that.
All good. Alrighty. All right. What is ProveX and what does it do?
Yeah, let's get into just a high level here. So Richard Hart, he founded Hex, right? A lot of controversy there. We've been investing in it for quite some time because they are solid products. They tend to come out with various products. The community is very strong. They have tons of people out here pumping out content, always thinking about ways to make things better. You can't, whether you like the investment or hate the investment, it's irrelevant. You can't downside. You can't just look past some of these products that are getting created. ProveX is a very interesting product that's come out that I think people need to pay attention to, because this, if it does what it's claiming it's doing, and by the way, we're in beta, it's only in beta, it will quickly allow for onboarding into crypto DeFi exchanges with bypassing central exchanges. Now, what does all that mean? Some people that are in crypto don't quite understand it. We're gonna have a video, we're gonna go through it and we'll see what that looks like. But ProveX is basically part of the Pulse Chain ecosystem. This is the thing that Richard Hart copied. He literally forked all of Ethereum and created Pulse Chain. You could say, all right, so basically what he did, he just copied the entire Ethereum network and moved it over to Pulse Chains, what he did, creating duplicate copies of everything on the Ethereum network. What does that allow him to do? Or the OA or whoever's in charge, right? What it does allow them to do is they can take any updates from the Ethereum side and move it into Pulse Chain, allowing to essentially cherry pick what updates they want to apply to Pulse Chain or not. A good example would be, you want to have that abstract layer to be able to decide what you want to bring in, because what happens if certain updates to Ethereum start forcing or exposing people's identities or CBDCs, things like that. You can control what comes into the chain at that point, whether you like it or not. And that's just a small example. I'm using that as an idea I think everybody could follow. The other thing that it does is Vitalik just came out last week and kind of threw a little curveball for all the L2s out there, and stating that it's not really a scalable problem that they're having. I know I'm going to butcher this a little bit, so I do apologize, but I would recommend looking into it. That the Ethereum, the L2s are hostage to what Ethereum does. So they're going right off the source code of the Ethereum, and L2s are essentially just, you consider it like an extension of code on its own chain, its own blockchain, but it's connected to Ethereum, but it has another layer of code or whatever the features they want to put on top of it. Completely different from how you copied Ethereum and created Pulse Chain. One's a straight up copy, another one is building on top of the Ethereum blockchain. So those are the concepts you need to know the difference of. And the L2s, Vitalik basically came out stating to the L2s that they don't need to be focusing on certain things. They need to start thinking about bringing new features or more features to their customers and stop worrying about scalability and things like that. You can agree with that or disagree with it, but that's basically how he stated it. A little bit more to it, but that's kind of the bluff, essentially. Now that that's out of the way, since Pulse Chain has gone live, and it's been live for what, 2-3 years, they've got a lot. One thing that you can't say, the Hex staking system that was on the Ethereum network, and now it's been copied to Pulse Chain. You can do stakes. It's never gone down. It's never crashed. Never had outages. On top of that, so it's had 100% uptime. All of the products that have been created on Pulse Chain, the main ones that have been blessed I know we've talked about liquid loans. We've talked about, some of the other ones out there that we've talked to with actually the founders. Solid products. They're doing what they're supposed to be doing, and they're bringing interesting value to the chain. So I can't speak for all chains, but this chain's got a lot of activity. It's just that people don't really follow it and see it because of it's getting muted by the price action of Ethereum, because unfortunately all altcoins right now and the whole environments are being muted by the price action of Ethereum. Nobody really cares because they don't see price go up. They see price going down, so no one really cares. But the products that are getting built are fantastic. Now we're going to dive into PROVEX. PROVEX is another product being built on Pulse Chain that is going to essentially allow people to what we call onboarding. And onboarding is, how do you take money in the fiat world out of your bank, or we'll call PayPal accounts, Venmo, and all these other payment systems you have. How do I get that money into crypto? And that's where we're going to dive into this video. We're going to go into it, and we're going to what do those steps look like today, and then what does PROVEX do to replace those steps? Did I miss anything, Zia?
No, that's a very good overview there. Yeah, Pulse Chain is the ecosystem that's built to be faster, stronger, more decentralized, but it pretty much uses Ethereum as a base. And then back before we went to the old proof of work concept, or from proof of work to proof of stake, it was already marketed as going to be proof of stake. So Ethereum kind of caught up with Pulse Chain on that one. But yeah, that's the basis. This is a Richard Hart product, which really is one of the big taglines for this one, outside of just the functionality of it, which is massive. But this does fall in a unique space where it is one of the official things that was created by Richard Hart, who is the founder of the chain, which is why it has a good bit of weight behind it just because of that. And the guy has a pretty darn good track record of making good products, I'd argue. But like you said, the entire altcoin space is down right now, so people aren't really too focused on altcoins. In fact, I would argue they haven't been focused on altcoins much this cycle, aside from the few times we've run. This has been a Bitcoin cycle. So stuff like this doesn't really get its time in the light, but we do believe that this is a bit of a fundamental change in the world and the ecosystem. Is it brand new? The answer is no. But if implemented correctly, this can be a game changer, which is why it's worth talking about. So with that being said, let's take a look at what we got here. So coming to us from Hive. This is the video that they put out here. Bit of an explainer on PROVEX on Pulse Chain, and we're just going to be going down two of the major talking points here, which number one is the middleman problem, and then number two is what are called zero knowledge proofs. It's cryptographic stuff, so as long as you can get the high level stuff and understand what it's doing, you don't need to know how to do it, because it's pretty complicated, by the way. But with that being said, let's get into it. All right, here we go.
Let's see what their own materials have to say. Okay, so first up, the middleman problem. Before we can really get our heads around the solution PROVEX is offering, we have to understand the problem they're trying to fix. And it all boils down to this kind of central irony in the world of crypto.
You know, the whole point of crypto, way back when, was to get rid of middlemen, right? To cut out the banks. But what happened? Well, ironically, a whole new set of massive middlemen popped up, centralized exchanges. The entire argument from PROVEX is that this just isn't what crypto was supposed to be. They see it as a betrayal of that original vision, and they claim they've built the system to fix it.
And wow, this is basically their battle cry. It's this big, bold statement that the old way of doing things, having to trust some company with your money, is completely broken. And their answer isn't just another company that promises to be more trustworthy. No, their whole deal is a system where trust isn't even part of the equation.
So, if you're throwing trust out the window.
There you go. So, middleman problem. Currently, the way that things work in the system is that pretty much whatever route you go, unless you're dealing with real DeFi products, you are having to use another company somewhere else that is run by people, operates off their infrastructure, and can run into their own issues along the way. So, in this case, if you want to get money on in crypto, you have to go from a bank to a central exchange, which either case you have to make sure that your bank wants to allow you to put your money into crypto, and then also your central exchange is available in your area. Additionally, keeping the money on a centralized exchange, it's not in your wallet, so you don't technically have control of it. What you have is an account with a ledger on someone else's ledger as well, meaning that they are keeping track of your stuff for you. What that does is that, again, it introduces failure points. So by removing the middleman, which is what PROVEX is trying to do, it pretty much gives you full control of what you're doing so that you always know what's going on and you always have a hand on the steering wheel. You never have to just trust someone else being like, yeah, I got that thing. I'll hold on to it. It's nope, full control all the time. That's what we're doing here. Am I missing anything, Tracker?
No, but let's talk about how big this is, meaning central exchanges. So you've already gone through a bank that you have, right? So you've already gone through setting that up. And then you might have a PayPal account, Venmo, or something like that. You've gone through the proper channels to set that up. KYC happens all there too. So now all of a sudden you want to go to crypto. Well, the only way to get really onboard into crypto is you need to go through a central exchange, a Coinbase, a Binance. There's numerous other ones. But like Zena's saying, that's a kind of like a brick and mortar. You're now having another party to go through. It's just another failure point. And crypto is being targeted so much with hackers and spams and spoofs. I mean, list goes on and on and on. Coinbase just came out in 2025. They had a bunch of customers that got hacked. Now, I will give kudos to Coinbase. They did state that they would refund people's funds, that at least the US customers, they were going to refund their their money for those hacks that happened. To give you an idea how much money we're talking here, in 2025, roughly $1.5 billion was linked to central exchanges doing hacks. In 24, 2.2 billion. And and the list goes on and on with central exchanges. They are a failure point because you're dealing with humans. You're dealing with another piece of the puzzle that it's not even really needed, but you have to go through this currently right now. And that's one of the big issues. Certainly if you want to go to a DeFi chain or anything like that. Now, if you want to just onboard your money and go to a central exchange and invest just like a trading account, then so be it. You can absolutely do that and go through that. And I think we always, advise people, and I don't want to say financial advice, but we do always say, hey, for our own personal benefit, we like to have many different central exchanges for onboarding and offboarding, because some of these central exchanges will run into problems. They might have too much frequency and then you can't get transactions in. Some of them might be hung up. Some could go through some legal action, and then all of a sudden you can't even use that central exchange. So a lot of times we recommend people taking about 3 or 4 different central exchanges, so you have a cornucopia of opportunities to go through different channels. But if you could bypass this, it's wonderful. And this is what we're about to go into next. If we bypass these central exchanges? Because currently right now, at least in the United States, you cannot.
Yeah, big answer on that one is no. All right, here we go. Section 2. What are we replacing trust with?
What's left? What do you replace it with? Well, according to ProveX, the answer is math. Simple as that. Specifically, a really cool type of cryptography that lets you prove something is true without revealing the how or the what. And this right here is where things get super interesting. Okay, so let's walk through how a swap is supposed to work without any trust involved. It's actually pretty straightforward, just 3 steps. Step 1, the seller proves they sent their coins to a smart contract, basically putting them in escrow. Step 2, the buyer proves they paid, but, and this is the magic part, they do it by generating a proof from their bank without ever sharing their login or personal data. And finally, step 3, the math settles it. The smart contract checks both proofs, sees everything is good, and releases the funds. The whole thing is automated. No humans, no trust needed. So the tech that makes all this possible is called a zero-knowledge proof, or ZKP for short. Now, what is that? Well, the classic way to explain it is like this. Imagine I have to prove to you that I know the password to a secret door. Instead of telling you the password, I just open the door. You know I knew the password, but you never learned what it was. That's a ZKP. In the ProveX world, the buyer's browser extension talks to their bank and spits out this cryptographic receipt. That's the proof that says, yep, payment sent. But it never, ever reveals their account number, password, or how much money they have. And because of this tech, the project claims it has some serious advantages. They're talking about a user experience that kills what exchanges offer today. Instant, private, and you never give up your funds. Then there's this idea of a composability moat, which is a fancy way of saying once someone integrates this, it can be used for a million other things. They also see huge demand coming from all over: finance, identity, you name it. And maybe the most important part, it's credibly neutral. Because it's all just math and code, it can't play favorites. All right, so that's the tech. It's pretty cool.
All right, pause that right there. So great simplified explanation on the ZK proof. So what he's saying here is, if you've already KYC'd into your bank, or you've already KYC'd into your other payment systems, Venmo, PayPal, what and so forth, then why do you have to KYC again? And that's what he's telling you, is that if you're the sender, if you're sending money from one of those entities to another chain, the zero knowledge proof, or ZKPs, basically have already verified that it's you, but without having to expose, valuable information about you. It's already done the work. So you don't need a KYC again. It's going to be very interesting to see this, because I mean, people have been pounding the table on KYC, but if this does truly prove that, and it solves that problem, then like he's saying, this application could be applied anywhere around the world. I don't need a KYC every single time the money transacts through something. Because let's face it, the TradFi wants to track every penny going anywhere in the world. Well, because and of course you'll always hear the political answer, which is, well, we got to stop terrorism, we got to stop black markets, blah blah blah, and all this. Okay, maybe so. There's truth behind that, and then there's also truth where it seems like, okay, well, where does your privacy come into play here, right? Well, if this is a way to do both, then fantastic, because now you can't send something from some place without having KYC, so it's already been checked, and at the same time you'll have your privacy. It's a very unique solution to the problem. So they just came out with this. Now, the video you just watched, that came out 2 months ago. That was talking about it. ProveX beta version just went live. What was it, 5 days ago or something like that, 4 or 5 days ago? And there's actually an interface. You can go out there. You can change so many different types of currencies from around the world. It takes a lot of different currencies. It takes anything from that to your payment systems, to your bank accounts. I mean, whatever you want to basically pull from, you have a massive amount to choose from, where you can then take the money from that, we'll say fiat, the bank or your payment systems, send it to Pulse Chain. And when it gets to Pulse Chain, it will appear as USDC on Pulse Chain, is how it would be in the stable coin. So instead of having to set up and if anybody has listening, has never gone through KYC for a central exchange, I highly recommend go out to any central exchange, Binance, Coinbase, any of them, Kraken, and see what you have to jump through hoops. I mean, the only thing they need now is pretty much DNA. At this point, after they've gone through it all, you need full facial record scanning of your face, going through everything. You have to send IDs, bank. I mean, it's a pretty extensive. It's right up there with probably trying to get a passport. It feels like half the time. So there's that, and then the waiting time. Well, it's just a huge deterrent for people who want to get into crypto, and certainly in DeFi, just crypto in general. Because most people who don't even know about DeFi, well, I just want to buy some crypto coins. So how do I go? We'll go to a central exchange. Okay, I'll go in there. And then you go through this, and it's an overwhelming process. So it's just a huge impediment to bring customers on. It's a hard entry level to get people into crypto that way. And if this is this simple, then this is going to really make it very simple to look at and do. The other things that I think it could help with, now, that's just the onboarding aspect. Now, if you can apply the 0K, knowledge proofs, the ZKPs, if you can apply this to a lot of other mechanisms, now you start to open up a whole world of what else you could do with this. Because now you're talking about how the whole world works today. And this could be a disruptor in that sense, where, okay, I want to send funds or do something, or set up a new, we'll call it a new widget, whatever this widget does. This widget does something that nobody really has. Kind of think about it like how you couldn't have Uber until you had payment systems, like, payment systems you have, and you couldn't do that until you had Wi-Fi, and you couldn't do that until you had cell phones. So all of this infrastructure had to be in place before you could do it. This is another product or another piece of software to that puzzle to now will open up more applications to do things with. That's another thing it opens up the door to. Things that we haven't even thought about yet. So that's another piece of the puzzle that I think people are missing as well by doing this, because you don't have to, once again, I want to interface with something that's something new. I don't have to jump through hoops. I can just go through this technology on the back end. If it is done this way, then it's very easy entry.
Yes, the main aspect that I think we're excited about is the ability to go from cash to crypto very easily. But even inside of the crypto space, there is tremendous use cases and examples for having zero knowledge proofs and this stuff, where if you want to do swaps in crypto, go crypto, going this way, you can do it without having to go in a liquidity pool. But the big one here is that it's combining the layers of crypto with the overall infrastructure of banking and whatnot. because if you look at the beta as it stands right now, we can look at all the different things that are already plugged into this. We got Venmo, Cash App, PayPal, Zelle, various different currencies from banks and stuff. Like, it's designed to bridge the gap, because in crypto previously, it's like you got to find a way to get on there, and then once you're on there, you can start doing all kinds of swaps. But then the extra step you have to go to every time you want to go in or out of crypto is you got to find an off ramp, aka a central exchange that's going to be willing to go to your bank, that kind of stuff. This is skipping right over that without having to have those guys. And in its place, we have trustable, immutable code that is backed up mathematically and uses cryptography instead of people keeping ledgers. That's the big one here.
And the other big one here is it also, we've just talked about on-ramping. Well, what about off-ramp? On-ramp is when you're going fiat to crypto. What happens when you go to crypto back to fiat? It allows you to do that too. And then, of course, people will say, well, you're going to need central exchanges because you have to be able to track taxes and all this. No, you don't. No, you don't.
You can track taxes on your own. There's software for that already.
Yes, that, and also when you send the funds back from crypto into your bank account or back into whatever payment system you're seeing, it's going to be tracked there. That's where you're going to get your tax forms from those entities. You have to pay tax. So it's not bypassing any regulations. It's not going to like bypass the tax man or anything like that. So it satisfies that problem too. So now you have to ask, all right, I'd have to hear what's the argument? What's wrong with this? Because if they say they just don't want this, and when I say they, I'm referring to governments, then okay, then you obviously have more going on and you're not telling us. Why you don't want this technology. But as of now, there's been no pushback. I think it's a fantastic product. But the fact you can also now go off on ramp and off ramp, this is huge. Because I can tell you now, the way it was before to get the Pulse chain, you had to not only have a central exchange, send money there, okay, wait for that to settle, take anywhere maybe the 3 to 4 or 5 business days. Once that money settles, then you can have to transfer the funds from the central exchange to typically it had to go to an Ethereum network or one of the networks like Binance and a couple other ones. Once that money got to the Binance network, then you had to use something called a bridge, and that bridge then had to be, that's where you move the money from those other networks and move the money to Pulse chain. And then keep in mind, every time you're going through here, there's a transaction fee. There's a little, you're getting taxed along the way the whole time. And then heaven forbid you make an error or you mess something up or you send it the wrong place. Oh, you just lost all your money. So to get into Pulse chain, to do all that was insane. Now there were other things that were being created to allow you, but the bridge helped. Sometimes that bridge would get congested heavily. It would get during high peak volumes. It might take hours before it appeared at the other side because it's just you're going through whatever bridge portals that are available for the user and customers at that time. So you run into basically bottlenecks. So that's a lot of jumps. Go from your bank to a central exchange to a crypto network. You send the funds and then have to use a bridge to go from there to Pulse chain. That is a lot of steps, man. And now you're saying you go straight to bank, right to Pulse chain. Wow. I mean, I think that's what you have to understand. When you compare the two like that, how many steps and how many chances to make mistakes and issues, and then you have another thing called slippage. There's that problem too sometimes. Now, there's just a lot of issues you could run into. So yeah, it's very interesting technology. I think it's definitely going to be really cool to see. I'll be interested to see if other chains start to take this on as well, other DeFi chains, if they start looking at this too. I know that people in the crypto world are looking at it, so I'd be curious because Pulse chain and Richard always seems to get a lot of backlash, but they don't ever seem to get kudos for what they do. And keep in mind that the one big thing he got a big standing ovation is when he did beat the SEC, right? Was it SEC he beat?
Yes,
right?
the SEC. Never forget that one.
Now there's only a few cryptos that have done that. His area did it. XRP did it. Who else?
Bitcoin. Some of the central exchanges. But the big difference here is that it's not like the SEC under the previous leadership who was suing everybody. They just dropped a lot of the lawsuits and the investigations. This one actually went before a judge, was adjudicated at a bench level, and then dismissed there, meaning that is the win. That's actually on record as justification for why it was not correct. It's not saying we're no longer interested in pursuing this. It's no, you were wrong. the SEC was wrong in this case. So that's why it's the big win.
Yeah, and hardly nobody can say that. So that's why
Exactly.
it should get more attention than what it does. And of course,
Sure.
the products they come out, which is just another product. So pretty cool to see.
True. Already, bit of a wrap on that one. Good fun start to the show because the second half is we're gonna be talking about the bloodbath here. Are you ready for the Bitcoin price, sir?
Well, it's got to be better than what it was at the all-time low, man.
This is true. Alrighty, so ladies and gentlemen, the last time we spoke with all you fine people was back on Monday, February the 2nd, where we closed that day at $78,000 Bitcoin. And if you remember the show then, we were saying that this is coming at a very important time, largely due to bills going through Congress, 60-day cycle, and then also we're kind of at a teetering point when it comes to is the 4-year cycle correct or incorrect? And well, since then we dropped all the way down to about $60,000. I think we even got a hair under it at about like 59.9 and change. So very aggressive drop, especially over the course of 3-4 days, but immediate pullback right up to that 71,000 level. And then since then, we've been hovering around that area. So big question is, why did it happen? Well, a couple of possible answers for you. The sad part is you're never going to get the one correct answer because, well, it's a very complicated market. But things we were looking at, ETF outflows were going, leverage was getting flushed, technical breakdowns. Like if you're someone like me that does the 60-day cycle tracking, you'll notice we were hunting for a 60-day cycle low, and boy, did we find one. That's based on more of just like market psychology that's observable over patterns and time frames in the past and stuff. But pretty much what it was not. There was no big chaos, no big hack, no ban, no failure of fundamentals. This was pretty much just purely price action. But at the same time, one of the important points here is that we dropped all the way down to 60 when we were sitting about $97,000 less than a month ago. So again, a big drop when theoretically, if you're one of the people that's looking out at all the banks, or excuse me, all the exchanges, all the different companies that are getting involved in crypto, releasing exchange traded products, if that's the case, then that means that a lot of money should be coming into crypto and we're building, right? Well, the price action tells a bit of a different story, especially when you take into account that everyone's favorite gold and silver still continue to go up during this time. So why was Bitcoin the one that went down? The answer is largely just price action in the market due to liquidity, sentiment, and boy, did sentiment get low. Coming over to our crypto fear and greed index. We are in the slight recovery, if you will, but we are still in extreme fear. We're at 9. This is an index from 1 to 100. 50 is the average, and anytime you get below 20, that is called extreme fear. Well, according to the data, we got all the way down to 6. That is very, very low. We have seen some very low readings previously, but that's largely due to all of the various things that have been going on, whether it was the October 10th issues, massive sell-off, the greatest liquidation event in history, additional price dropping down. December 16th was another day that we had that went down. That one was surrounding when we were renegotiating tariffs with China as well. But this one in particular, very, very low. And stayed there for a couple of days, slight recovery, but now we're back down. So all the way from 9, 6, 7, 14, back to 9. Additionally, we flip back over to the chart. RSI, our relative strength indicator, got all the way down to 16, 15 is how some people had it based on which chart you were looking at. This is very, very low. Because keep in mind, we get into that oversold area at 30. We got all the way down to 15. And again, this is indexed from 1 to 100. So the further down you go, the harder it is to get down to that point. That's why this is a big event that people are looking at, and it's the real head scratcher. We flip over to this one. We have Michael Von de Pope. He's saying the fear and greed index has hit 5 for him, lowest ever recorded. RSI hit 15. These two levels were only seen in 2018, following the 2017 all-time high, and then also during the COVID crash. So if we look at the chart, this is what we're seeing. Back in 2018, when we hit 3K, and during COVID, when everything dropped, obviously, down to 4K. Now, we're sitting here at 62 at a time when realistically, we're not looking for cycle lows. Because if that's the case, then that means if we're looking for cycle lows, it means we're looking at 4-year cycle theory. 4-year cycle theory, the timeline is end of 2026. Last time I checked, we just started 2026, meaning that there is something afoot here that's going on outside of the ordinary. Additionally, other people are also pointing all this stuff. But in this case, the sentiment is very much along the lines of, well, if it's being sold, it's undervalued, and it's the time to accumulate more than ever. Well, let's take a look at the old strategic reserve chart. Ah, look at that. Bitmine's been buying. Okay, are we surprised there? Not really. But additionally, a lot of other folks are buying as well. If we flip over to Cointelegraph article here, crypto investment outflows ease after 3 weeks of heavy selling. Okay, we just had the selling happening. It's slowing down. These are exchange traded products, right? By the way, not just ETFs, but ETPs, everything involving the exchange traded funds. Okay, if selling is slowing, then that also means that people are buying to offset it as well. Additionally, where did you go? Yep, Bitmine buying up. Come on. And reports that people are taking advantage on the Bitcoin side as well, meaning that there's still a lot of players in this market that think that it's not over, and in fact, this is an excellent opportunity. That being said, the question is still very much in the air of is 4-year cycle theory true or not? And well, we're just going to have to wait more time to see if that one really pans out. So last week we were talking, I said that if we broke down below 70K, I think the odds of having a bear market go up for sure. I still definitely believe that. However, one thing that gives me hope that we're not fully in bear market, trying to play both sides on this one, by the way, is that this recovery was pretty immediate, meaning that we went all the way to 60, bounced all the way back up to 71. That is a very large recovery. If we look in the past dips that we've had, especially after the big ones, this sort of recovery never really happened. Even after the greatest liquidation event, we went from 110 to about 115. And back in November, we went from 80 immediately up to 92. This is about that size, but this took over a week to happen. This one happened in less than 24 hours, meaning that the market was ready to buy back up the price. So, crash.
Look at your volume, Zena. Just to not, I don't want to steal your thunder, but look at your volume.
Good.
Your
That's
volume too. The volume.
The volume was very, very large. Let me try to make this more visible for you guys.
On the down, but then the buy back almost matched the sell off of the volume down on the same within 24 hours. I'm between the two.
Correct. So volume are these green and red candles at the bottom. Shows you how much flow is going in and out. Again, one big day, that's really the big one that we had. That was Thursday, the 5th of February. The next day, the 6th, pretty much right at the same size. That is a lot of volume, especially when you take it in comparison to everything else that's been going on. Because even when we back had these candles, sure, we had one or two decently sized ones going down, but we also had very similar sized candles the 2 days before it, and then way overshot it on the day that it actually dropped pretty heavily. And then additionally, overshot it again on the way back up. So, volatile market, yes. End of a bull cycle, I think not, but I still do believe that the case that the 4-year cycle could be true. This is one more point in that category. And if you remember, the things that were lining up for the points for 4-year cycle being true, we had time frame hit, we had 50-day moving or 50-week moving average hit, we moved below it, and then additionally, last week we talked about the 21-week exponential moving average. Again, went below that one as well, and this went even further. On the other side, we're still saying that there's still a lot of hope out there for people thinking that this is just a temporary dip and that we're going back up because of everything going on, the amount of investment, the amount of deregulation, the amount of correct regulation coming in from market structure, all sorts of investment, people talking about it, hype, integration, all this kind of stuff. That is still very much out there for folks. And in fact, during this time, people are even doubling down on it. Michael Saylor had a video he released where he said pretty much exactly that. He's like, people are looking at me and saying, why didn't you sell when you're in profits? And if you know Michael Saylor, he doesn't look at this as something to trade with. This is forever cash to him. He even made the claim. He's like, yeah, well, what if this price was 1 million? Would you be asking me these questions? Answer's hard no. CZ came out saying that, expecting very similar things. Additional other folks, want to say Larry Fink came out there saying that now is a golden opportunity. I have some of those clips primed for you guys in a little bit. We'll get to them, but I just want to go over the price action first so that we understand where we are, what's been going on, and what's the probabilities of things to come into the future. So, speaking of probabilities, if we move down further, well, we'd expect another retest of this 60K area. That's typically how these things go. Once you find a support line, you got to retest it. So, if more downwards price action does happen, probably going to go retest that 60 area and then maybe settle there or potentially blast through it. Other side, this could be a 60-day cycle low, in which case we might not even go retest it. Instead, we're going to be looking to start moving towards these higher levels. So the next one we're looking at is about 74, 75,000. I'll flip on some indicators real quick. Here's what I'm looking at. Looking at the drop here, this is pulling a Fibonacci retracement. Key levels that we're looking at, by the way, I drew this on the 6th of February before the recovery. What we're looking at is that 0.5 fib line. That's something we got to test. I think it's especially important because it has a good degree of confluence with the data that we had from the 4 days that we were sticking around there. This 76 level appeared to be a decent little bit of support before we broke through it. So going the other direction, that's one of the levels we're looking at. Additionally, after that, 84,000. Again, it's right at this support level that is probably now flipped into a resistance. And then after that, looking up at that 94, 97 range. But as it stands right now, we are where we are. And the answer to that is $70,370 for Bitcoin. The magic third option here, the one that we don't like to talk about. Okay, if it's not going up, it's not going down. That means it's going sideways. If that's the case, then what I would expect to see from that is a trading range form between our 236 level and our 5 level, but more realistically, that support level or that resistance level just before it. So anywhere between 75,000 and 67,000 before we start to see a move again, either direction. And keep in mind, markets do crab sideways. We had a lot of that during all of 2024, if you remember that part. So, Tracker, any thoughts on the analysis here?
No, I know last week you were talking about if we break down, we'll probably split right through there, and we certainly did. I was still thinking, we have a ton of pockets of support. There's a big point of control right on the top of the 71,500 area, we'll say, which was that consolidation area where we finally broke out back in October of 2024. So now we're going back. If you think about it, this market has just basically backfilled. It's just backfilled the gap up is all we've done. And if you look at it, we also normally come back to these same points of breakouts on that. And that's typically a healthy chart, healthy market. We always go up, then we backfill, we come back down. We've already had a huge correction from the highs down. You're like, well, we're going to go lower. But see, here's the thing that everybody, and I know I keep saying this, but you're in a more mature market nowadays. Meaning you're not going to get these big, at least in Bitcoin, you're not going to get these big monster moves. They're getting smaller and smaller because you're getting top of the S curve, right? Things are getting smaller and smaller on these moves up and also on the way down. Now, and we always talked about max pain. We were talking about that. So we've gotten kind of pretty good max pain to the downside for the bulls, but can we get max pain going now in the opposite direction against the bears? And what would drive the bears crazy is a lot of people want to be buying in that 50 handle, $50,000, $55,000, maybe even lower. They're looking for a price action to come down there, and you're going to see an aggressive buy-in. There's a lot of people looking at these levels down there that they'll start buying. Who's to say that it doesn't get down there and it starts to go back up? That's going to be max pain for the bears because they're looking to get back in. Kudos to them. If you got out because you were thinking of the 4-year cycle, great, you did that. I'm still in the camp that I don't think the cycles really matter anymore. But if you did, it worked out great for you. So kudos to you. I'm sorry. I think you're going into a more mature market. I think the cycles, and I'm not talking about the 60-day. I'm not talking about the the trend cycles that we talk about, the Elliott waves. I'm not talking about necessarily that. I'm talking about the fact that, because we went into a whole detail on why the last 3 cycles that always matched up on the 4-year cycle, and a lot of it comes down to the liquidity, risk on. Typically markets go in a 4-year cycle because of that liquidity, because of how the governments work and how they inject cash into it. So there's a lot that kind of adds theory to why that seemed to line up, and rightfully so. But this time it's a little different. Keep in mind, markets were getting kind of suppressed on the way up, and everything was real muted. We never had an alt season, really. Come on, really? We're gonna say March 2024 was the alt season, really? Come on, we're gonna say that. So we never had euphoria in the alt season. ETH has never really done what it never did anything close to what Bitcoin did. Yeah, there's some outliers like Solana and XRP had their moments, sure, but very select few. The entire alt season has been muted and everything's being stranglehold. So if you're saying that everything's going to drop now because of the previous, well, we didn't really do the same thing on the other previous on the way going up. So why would it stay true to the way down, right? And keep in mind that all these, I know you're going to probably bring it up in a little bit, but all of the tailwinds that are starting to come our way, I just feel like that if it got down to these lower levels of 50,000, you're going to have massive amount of accumulation. And it's funny, like who keeps buying? The institutions keep buying more and more and more. So you're in a very interesting time where crypto is trying to disrupt the financial institutions. TradFi has gotten their hands in here now, and there's a lot of games being played. If anybody tells you the price is going to go here or there, and they know for sure it's going to be here, certainly when they're throwing out times, just stop. You don't know really, but all we can do is based off of the price action and what most likely the areas, if we go down, these are most likely at support levels during a point of controls, good pocket, support or resistance on the way up, using the fib levels certainly to kind of give some indicators on that. But like you said, on the sell-off now, extreme oversold conditions and everything went way too fast. And anytime you can just look at markets simply as a rubber band. If you pull it really far, it's going to snap back. And that's what you're getting. You're going to extend. How much is it going to snap back? Typically a 50% retracement from the recent drop to the low is pretty much where you normally would go. And I think that's in line with those fib levels you were saying. But keep in mind, crypto wasn't one just dumping either. The gold and silver trades were unwinding pretty aggressively all at the same time. So I think what was happening, and this is, you can come up with all the reasons. People want to try to understand, like, why is this happening? And of course, mainstream media will always, oh, we got the answer here. This is what it is. No, you don't. Like, I think there was I think it was just a good excuse for people to unwind the gold and the silver trades. Keeping in mind, a lot of people in crypto have been rotating into those trades, because they seem to be hot. They're trading like a meme coin. And I think you saw some of the speculation come out of those pretty quickly. Keeping in mind, silver and gold, they don't move like this ever. I mean, once every 40 years, maybe. So they're going parabolic. And I get all the reasons for gold and silver because of the lack of confidence in the fiat US dollar, and the BRICS are very dropping treasuries. And I get all that, and that makes sense. But you still don't get these massive parabolic moves like you do. And I feel like it could be a combination that the suppressing in those markets has been the demand, the physical demand has outweighed the suppression. Because let's be fair, silver, gold, all these have been manipulated for a long, long time and been suppressed for quite some time. And now maybe this is not coming home to roost. I know the banks were shorting gold and silver aggressively, and I'm not going to go down that rabbit hole, but you can look into that if you'd like to look into it. But that was happening. But what I'm trying to come back to is, like, there was a lot of sell-offs. You had the trades unwinding on the same time. You had crypto dumping. There was speculation. People were throwing out mixed signals that the new Fed is hawkish and no, he's dovish. So a lot of just mixed signals going on all over the place. And typically when you have all this uncertainty, people aren't sure what's going on. People tend to make action and unwind their trades. And I think people in the silver and gold trades who have already been in this long periods of time are doing what they should be doing. That is taking some profits. I'm not saying to rotate it out, but certainly we've been saying that here. If you've been in those trades, try to unwind some of those, take a little bit off the table, something, don't get too greedy. And if you did that, then you're probably looking pretty good right now. And even though you're still holding your positions, you're okay. Could silver and gold keep going? Sure. There could be more demand and more movement to the upside. I just feels like that it's gone too far too quick, and it has to go through some digestion period. And what that means doesn't mean it's got to tank more. It might just go some sideways consolidation going for a while. Could be some pullback, could go back and try to test the all-time highs, but I think you're going to see more of a sideways consolidation on those two metals because there's been so much speculation come into them. Crypto now, I know we're going to get into the zenith, but there's a lot of tailwinds coming right now. And that's the other thing. Who was dumping during this whole time, and who was truly dumping? Because all the big players, they were buying on the way down. They were gobbling it up.
That is one of the big questions. I pulled it up previously, but again, liquidations. These two candles here, those are our real days for liquidations. We had about 2 billion and 1.2 billion. Keep in mind, this is also after we had a 2.6 billion and also a 1.3 billion day previously. Because remember, we streamed right here between these. So we were looking at this, trying to figure out what the heck's going on. And then we had another one happen. Interestingly, though, if we look over at the ETF market, not a whole lot of outflows, actually, all things considered, and even some inflows for the 5th and the 8th. So pretty much the days after everything happened there. And it's a little puzzling when we're looking at these, which is like, did people get liquidated? Yes, people get liquidated when price moves. That's just how that works. But when it comes to one of the new largest areas of money going in and out, the ETFs, not a whole lot of inflows or outflows. Actually kind of balance itself out there. So it's...
I would chalk it up like this. I chalk it up for this, Ian. Sorry to cut you off, man, but I think it's this simple. I think it's this simple. I think there's really nothing that people are getting excited about with crypto because you have this big Clarity Act pending overhang that nobody. So, and if people started dumping and selling because certain market makers wanted to sell, then you get this cascading effect, deleveraging, and then of course liquidating people starts to trigger this these moves to the downside, and it probably had something to do with that. That seems more logical.
I think that's a good explanation. And I even have some things for that, especially. So this week, we got an announcement on the 10th, aka tomorrow. The White House is hosting a meeting focused on stablecoins and the broader crypto market structure bill. But again, we're still around this one issue here, which is the stablecoin yield.
One question, just one thing I want to clarify for people, because I know it gets, some people are getting confused on this. Scroll back up, see what they called it? The crypto market structure bill. They keep calling it different things. Yes, it's that. It's also the Clarity bill, correct?
Yeah, so there's two bills as it stands right now. The crypto market structure bill, the big one everyone's been talking about, that's the one that came to us last summer and has been debated, marked up, went through the House, is currently sitting with the Senate Banking Committee. The second bill is another market structure bill, but this one actually came from the Agricultural Committee inside of the Senate. They work a lot with the CFTC, so that's what theirs was focused on. This one right here is kind of the big one. The other bill did get through that Senate committee, which is great because it has some good basic structures, gives good regulatory authority to the CFTC, where, in my personal opinion, a lot of these things should fall because guess what? They are commodities, so they should go with the Commodities and Futures Trading Commission. But some of the things are still securities, which is why we're having the SEC versus CFTC debate, which is housed in this bill. But additionally, this is the only bill that deals with stablecoin yield, which is why this is the big one that's been for debate.
Good explanation. Just wanted to clarify that because I think some people are getting confused between the different
Yes,
bills.
it's very easy to get confused on these. They don't make it easy on you. But anyways, here's the core problem. Still, all the other stuff seems to be hammered out. Everyone is honing in on this one big thing, stablecoin yield. Okay, why are banks opposing this? Traditional banks believe yield-bearing stablecoins could pull deposits out of the banking system. The argument is based on basic math. Savings accounts usually get 0.3% to 0.4%. Checking accounts, basically nothing. Stablecoins can offer 3 to 4% incentives. That's a 10x right there. So if you're looking for a place to put your own money, you probably should go where you're treated best. If you had to choose between these two, a savings account or a stablecoin yield, I can see where the massive incentive is. If that's the case, then that means that the banks are not happy about this, and crypto exchanges would be happy about this. As it stands right now, banks have regulation on being able to offer these products. Stablecoins do not. So the bill aims to change that, meaning that the people looking to push the bill are the people that are looking to help this structure come to the market for their customers. And the people opposing it are the people that don't want more competition, aka the banks. And that's really what this fundamentally boils down to. We even got our Coinbase CEO here. What's his name again? Armstrong.
Yeah, that's correct.
Ben Armstrong. Yeah. So quick here coming to us from CNBC. Let's see what the man has to say.
Well, I think the high-level principle here is that we can't really have banks come in and try to kill their competition at the expense of the American consumer, right? People in America should be able to earn more money on their money. I think stablecoins are an opportunity for banks. They should be able to build great product lines with this. It's an opportunity for crypto companies. Congress and the laws that get passed, they should really create a level playing field and say, this is allowed, this is not allowed. Now, all American companies, go compete, try to build the best products and services. That's great. What's not great is if the banks can put their thumb on the scale to try to kill some of their competition, and they only pay about, 14 basis points on the average savings account. Consumers should be able to earn 3.8% on their stablecoin rewards. And so we're going to keep fighting for our customers' rights and the 52 million Americans who use crypto every day.
I mean, what would you say to the argument that banks have put forward that because of the role they play in the economy, the loans that they make, if they do wind up seeing billions of dollars, as some have estimated would happen going from banks to stablecoin, they say that could have a big impact on the economy. What's your response to that?
Yeah, well, banks don't have a monopoly on lending money. Actually, crypto is doing quite well in this area as well. And crypto is a technology to update all parts of the financial system, whether it's lending, capital formation, et cetera. So I think banks do play an important role in the economy and making these loans. Crypto should be allowed to do similar types of activity. We're not engaged in fractional reserve lending. That's an important point, by the way, because the bank license, what that really allows you to do is fractional reserve. The banks don't have all of your money there. That's why there's so much oversight and you can have these runs on the bank. Stablecoins have 100% reserve, right? And they're all the assets now post-Genius are held in this short-term US treasuries. So in my view, it's actually a safer place to store your money, and crypto companies should be allowed to compete and offer loans just like banks.
There you go.
There's so much to unwind on that one, man.
I know, but the core fundamental here is like if you can offer the stablecoin yields to the American consumer, it seems like a massive boon. The banks are arguing that they are a very fundamental and linchpin part of this whole thing that we got going on. Do I agree with them to a certain extent? Yes, the U.S. has been really built off the banks pretty much since the founding. Being able to issue debt is very fundamental to a nation, and it's very important for people operating in the 21st century, as we've seen when it comes to car loans, house loans, personal loans, all that kind of stuff. At the same time, though, does that mean that you can only have that system or you can have both? Personally, I'm in the camp that you can have both, and I think it's a good thing because it's offering more competition in the marketplace, which theoretically should make it a healthier marketplace. Another big one here is that if you are skeptical about getting that like less than 1% interest rate on your savings account, and then this guy walks in and says, hey, I can give you 3 or 4% if those are stable coins, I understand why people are skeptical. But at the same time, he called out a very important principle there as well, which is that they operate off different rules. They're not doing fractional reserve banking. They have a 100% reserve rate. CZ even tweeted this out the other day saying that Binance was at 100% reserves for pretty much all the products that they offer. If you remember back in the last cycle when FTX collapsed, the big issue was they weren't doing that. Now, under the Genius Act, the stablecoin bill that was passed last summer, that is part of how that works now, meaning that there's additional protections in place. The companies are more mature. They're even a bit larger too, which adds a little bit of stability there. But fundamentally, at the core, what this really boils down to is just competition in the marketplace. And we're seeing two titans, honestly, kind of fighting over this, or rather the up and coming person trying to take down the titan that is the established banking industry.
Well, let me ask. The one thing that I don't understand is why they're bashing these. There's a lot to unwind, and I don't want to dive into all this. One thing that I don't understand. So banks do offer products like CDs and things like that are locked up for periods of time, so you can earn the yield. Typically 3 to 6 months, you can earn 4% ish. Now, most of these want to earn about 4%. Then you base on how long you want to lock up those CDs for, which are, you're locking up for treasury yields. But you're earning money to do that. That does compete with stablecoins. Stablecoins still have to be locked up if you want to earn yield on them. You know what I'm saying? Now you can take them out anytime you want. You're not locked into a contractual obligation. So I can unstake those. I think that's the key. They can take it out when they want. And that's the real kicker here. But the big reason why the banks are pushing back on this is 100% the fractional reserve. So here's what's going to happen. If this goes through, the banks are now going to have a bunch of money leave their banking system. That's what they're concerned about. Well, if you have fractional reserve, do you really have all the money? Or have you lent it 100 times over that same money? That's the big problem. You're going to have to unwind this bird's nest that they've created. And they're going to have to bring a lot of cash to the table to unwind this. That's one big headache they don't want to do, because that's what will happen. Now, central exchanges, absolutely. Maybe they don't do fractional reserve, but they've run into liquidity problems a lot of the times too. So they're not like, perfect when they keep saying they're 100%, they have all the money on the account. Well, then tell me why people are getting liquidated left and right because of leverage and how they're calling out, certain puts and calls that they have on betting shorts to calls. That's unwinding. This is a simple case that the banks are the big guy on the block and they're taking out competitors. And they've been able to do this for quite some time. Now crypto has come to fruition and it's grabbing some traction. This is no different than if you have any new technology that would compete. Google all of the incredible advancements and products that can generate energy. And look at how many of those things have disappeared over the years. Because the big company, the energy companies come out there and they'll buy them up and they'll get rid of those technologies because they don't care about the technology. They want to control everything. And that's the big problem here. So people should be absolutely asking for this and demanding that it happens because he's right. Banks aren't the end all be all. That's the big problem here. The banks have a lockdown control of pretty much how money goes to anybody, and they don't want anybody disrupting their ecosystem. And this is absolutely going to rattle it. 100% going to rattle things. Now, if I'm the banks, and we've already been talking about this, the banks are already positioned. So if this does go through, they're already positioned. They're already owning, ETFs and products. They're just going to have to now do some legwork to position and partner with central exchanges and probably do something of this nature, which is already happening behind closed doors. So the big thing here is the banks are still gonna earn a lot of money. Let's just call it what it's gonna be. They're just gonna have to move around and play nice with central exchanges, and they're probably gonna buy out the central exchanges or partner with them in some shape or form. And those deals are already happening behind closed doors, guaranteed. But that's the big issue that I have with it all. Is that this is the one thing holding it up. And I'm tired, and I know everybody else should be sick and tired of this. Anytime new technologies come around, they get suppressed and they get shut down. This is one of those stories and that's coming to fruition that needs to happen.
Yeah, to tie it back to price action, the reason I think that this story could be one of the big contributing factors for why we see what's going on is that as this fight has drawn out, we've actually seen people kind of double and triple down on their original positions. So going back to our post here, why are crypto firms resisting a ban? Well, crypto companies, especially exchanges, see yield as a core part of the business model. Some of them have even said clearly, if the yield is banned entirely, they would rather see no bill passed than accept a framework they believe protects banks at crypto's expense. That's how serious the disagreement has become. So, because we're getting more and more entrenched, it doesn't look like there's a whole lot of progress that's been made in the time that we've been talking about this bill, which is coming up on about a month here almost, actually. At the same time, though, outside of the basic yield functions, I personally believe there are still good things in this bill. One of them being the separation of powers between the SEC and the CFTC to have clarity, basic structure and definitions about who does what are they allowed to do and not allowed to do. These are the kinds of things that really allow an industry to understand what is in play and outside of play so that they can build properly. Up until this point, it's largely just been people that have been willing to take the risk and really make the jump and deal with the repercussions later. And as we saw under the previous SEC, that was a very costly and very stressful endeavor. So even just getting this without the yield, I think would be even a bit of a boon to the crypto market overall. Would it be a win to the exchanges? The answer is no, because they don't really get that yield. And as they stated very clearly, it's a core part of the strategy there. If they don't get that, you can probably just expect them to keep making money off fees and liquidations, which all the DeFi folks are pulling their hair out right now as I say that kind of stuff. But I think it was always inevitable that we were going to get to this point. I just didn't expect it to happen this soon. I thought that maybe getting just basic market structure could have been a good step one. Dealing with the stablecoin yields could have been a step two. I think we're seeing this largely as a result of these bills trying to be passed separately last summer. And we saw the Genius Act get through. We didn't see this one get through. So now that we've had the Genius Act for almost 9 months at this point, we see what the stablecoins can do. The banks see it. The exchanges see it. And that really puts people further into their camps. The silver lining out of all this is that this sort of legislation was very popular last year. And I want to say there were 19 Democratic senators that actually signed on to the Genius Act. So you can make the argument that we could see those same 19 folks jump onto this one, especially considering the big political football at the time. And by time, I mean literally last week was the government shutdown, which was centered over DHS and Immigrations and Customs Enforcement. But that one's been largely resolved. They passed an appropriations bill that left out DHS funding to get funded through, gosh, I want to say it's end of February, but the rest of the bill for the government got passed. So even if we do see another shutdown next time, realistically, we're looking at them like pulling funding for DHS, and that's only partial. So that issue seems to be largely subsided. So now we can focus back on this one. If that's the case, I can see more folks that are willing to actually vote for their constituents instead of party line and pass something like this. So look, it's a critical time because where we're at in the market, we were hoping to get something through. We didn't get it. We saw doubling and triple down into their positions, their camps. I think that had a bit of an effect on the market, which is why we saw the price action that we saw. But everything that we've been talking about the last month is still in place. We still have CPI starting to go up. We still have global liquidity definitely expanding. We have the business cycle appearing to, some people are claiming it's bottomed, which is kind of crazy to say. And then all this other stuff when it comes to people just investing in this. Like more money has been flowing into crypto than we've ever seen before over the last like 2-3 years. And it's not stopping from the numbers that I'm looking at. So if you want to make the structural case that, yeah, bull market's still on, this is just a temporary dip while we fight, similar to like what we saw back when we had all the tariff negotiations, I can see that argument. And people are making it, by the way. Let me see if I can find this. Here we go. Another friendly face or familiar face, excuse me. We got Larry Fink of BlackRock. What's he saying?
I wouldn't say friendly.
Yeah, agreed. That's why I corrected myself.
It's not about if our market's going up or down. Is there a bubble in crypto or is there a bubble in technology? It's about being in the market throughout the cycle. It's not.
Okay. He's not worried about a bubble. Let's see if anyone else is worried about bubbles. David Solomon, who runs Goldman Sachs, said we're sitting in one of the strongest macro setups he's ever seen. Okay, let's see.
This is as sweet a spot that I've seen kind of macro picture. Now, we are in a capital investment super cycle, like something we've never seen. Last year, the 4 largest companies contributed 1% to GDP growth with their $400 billion of spending. We are in a deregulatory unwind cycle from a massive regulatory surge during the last administration to a deregulatory wind back. That is very stimulative. All these things, it's just such a cocktail of stimulus that it's very, very hard to slow the economy down. This is.
I don't know about you. That sounds very bullish. Again, it comes back to like, are we looking at the crypto prices? Yes, we are. Are we happy that we hit 60K again? Not really. We're expecting definitely something else. And according to people out there, like they're seeing that things should be popping off. And I understand when looking at the fundamentals, but at the same time, I come back to the reality of it, which is we are where we are. We are at 70,000. We appear to have a possible legitimate 4-year cycle top. But at the same time, there's so many fundamentals that are going against it. And is this a crazy cycle to be a part of? Yeah, for sure. Shout out to our buddy West here. He said, dang, didn't think this bull run would be so lackluster, but oh well, I have a good position in Plus's ecosystem, so now it's time to fill up on Bitcoin, Ethereum, and Solana. Agreed. It's all heading south. Time to buy the dip of the fall off of the crash and the burn. Yes, agreed. And believe me, I understand for the folks out there, if you're looking at crypto and you see something like this, swap to gold and silver. Looks pretty scary. Selling for a loss. Very scary. Holding till zero. Also scary. Or buying another dip of the dippity dip. Yeah, a lot of dips. Could there be another one? It's always a possibility. It's again, like, look, I get it. There's a reason fear and greed was at 6, still sitting at 9. We got into this game for the volatility. The volatility's here, brother.
Yeah, it is. But
oh my gosh,
keep this in mind. We always talk about it's such a small, it's so tiny. mean, the silver market now is what, 2 times the size of crypto, if not more. Gold has just gone parabolic in the size of it now. So it's easy to get pushed around. Especially now, TradFi in here, this is easy to push this thing around how they want. And keep in mind, the people that are pushing it around are the market makers. You know, someone bought in, they're still thinking of the narrative, the 4-year cycle, or they've also been already in positions because they're institutions that, you know, you could say, are they suppressing the price because they want to see some clarity, they want to see something come out of this bill, and they're not going to let it run until it does. Possibly. I'm still in the camp that hold my positions. Once come down, I'll buy more positions, and then in long term, we're positioned because you see all the writing on the wall where we're going. Now you just have to have a long term horizon. These treasury companies that have been buying it up, like the BitMines and so forth, they're buying it up because, like I said, they're not looking at this as a 1 year, 2 year trade. They're looking decades. They're buying this out for the long term.
Yes.
If you got the longer your investment horizon, the more you don't really care about these long term. All you care about, honestly, is has the thesis change? No. In the short term, you could say, okay, 4-year cycle is in place, or you could say, you know, it's fallen out of lackluster. There's really no reason to own crypto now because the fact that it has nothing but headwinds with these other things, even though the macro environments are getting very bullish. So we'll have to wait and see. I think, to me, the only thing that's really holding crypto back is literally this bill. This bill can go through, and honestly, I don't even care if the central exchanges can do yield. Honestly, I don't care. Get it out and let's get it through. I don't care, because guess what? You can yield in DeFi. I haven't seen. I know they were talking a little bit about DeFi. You can yield in DeFi if you want. I don't care about the central exchanges. We already talked about their huge headache to go on onboarding, and I get they're more for the mainstream mass adoption. So I understand that profit, and I get it, and I do understand it. But the central exchanges are going to be pretty much partnered with the banks. They're going to be treated just like banks, and they are going to be that way. So what I find it kind of interesting is, why don't they just come to an agreement and get this thing through and let's go? Because when it comes down to it, the central exchanges are going to be owned by the banks. The banks have all the money. They have all the cap. They could do a hostile takeover if they'd like, so choose to do it. They can easily take over it. It's not even. Kudos to Brian Armstrong for fighting the institutions and trying to get some clarity here on what can we do. Why does it only the banks? Why do the banks have to be the end all be all? Why do we have to say the banks are going to tell us what we're allowed to do with our money? The bank should not tell you what you should have to do with your money. I mean, I don't want to go back into, the amendments, Bill of Rights, and the IRS and how it was created and the Federal Reserve and all that. I don't want to go down that rabbit hole. We've been there, done that. But what I'm getting at is they don't. But they keep coming back because when you control most of the lobbyists in DC, you have most of the power. And that's one of the big problems. And if anybody's seeing anything that comes from this, you should understand this is how it's so controlled, because everybody essentially is on the payroll by the banks in one shape or another, period. I don't care. You can argue this all day long. That's exactly what it is. So, but what's funny to me is the banks are fighting this, yet the banks are going to end up owning or controlling some of this stuff. So I don't know why they're so pushing back on it. They're going to earn much money on this. So I just hope that the central exchange can work out this yield issue, and let's get through it. Because if that gets through, we all of us here are going to do really well, because now there's no more headwinds. Now it's off and running, and the macro environment is set as a powdered keg. So liquidity is going to be pumped in, BSI is expanding, like all check. You're down the line. The only thing holding it up is this silly act, this bill that honestly for people in DeFi, we don't even care, but we need it for mass adoption to bring in more people into the crypto. That's all we care about it as. So let's just go ahead and get it done. I don't care that central exchanges can yield. I could care less.
Agreed. DeFi is, I think it's the way. But I do also have one final possible explainer that I have for you here, coming to us from Benjamin Cohen. He's saying the price of Bitcoin color-coded by social interest shows that Bitcoin topped on apathy rather than euphoria, similar to mid-2019, which also corresponded to an end of quantitative tightening. Okay, so basically, red is very interested, dark blue, not interested. Okay, what are we looking at? Well, 2017 had the euphoria top. I see that. Our double top had even more euphoria associated with it. And then we're sitting here at dark blue at our top this time, all the way through that top, by the way. The hottest we ever got was back in January of 2025. And then it really cooled off ever since we pretty much had the tariff dip there. And then it never even got back up to being hot. So
And you
look,
can thank the TradFi for that.
yeah, that's true. That's
TradFi
absolutely
got into at this point with ETFs. If you don't have these ETFs in markets, the market would run organically and it would be a true free market. Once you brought the ETFs in, certainly with Ethereum, Bitcoin its own thing, but Ethereum and all altcoins are mainly tied to Ethereum. Ethereum's price action, you were scratching your head. Wait a minute, we've topped 5 times. We've never really broke through with Ethereum. Like what? Yeah, it's clear signs of manipulation. Anybody could tell you that freaking thing's been manipulated. And the only way they could do that is through these ETFs by putting puts and calls on the actual ETF itself. So you can absolutely control and manipulate the price. This is why we never got the alt season.
I think that is a very good justification for not getting an alt season for sure, because the alt season is largely dependent upon retail traders that are interested in that kind of stuff. Sure, there's venture capital companies that are interested in building that kind of stuff, but they are nowhere near the size of traditional finance that got into this. And by the way, on this chart, I know it's really hard to see, but this little area right here, that is when the ETFs came out, and that's our pump afterwards. Didn't even get that crazy hot, still hot, hotter in January, end of 2024, early 2025. But it's interesting that you can, like, even on this like sentiment based chart, I can pinpoint to the day, partly because I know the price history, but I can pinpoint to the day when the ETFs came out. It's that tiny little green dot that's the one above the rest, and then we had the drop, and then we went all the way back up. Clearly, this is a bit of a lagging indicator because all the way back up is dark blue, and we finally heat back up once we get to the top of it. But it's interesting. Again, it's sentiment. I don't take this one too seriously, but at the same time, if you want to make the explanation of why we didn't get an alt season, this is actually a pretty good explanation.
I mean, and you can chalk it up for, you can call it a maturing market, whatnot. But when you have big institutions that come in here that become big market makers with a market that has low, I mean, what is it, 3 trillion market cap compared to, I mean, crypto used to be bigger than silver. Obviously, silver's had its run, so not so much now. We were trying to look at, can we catch gold? We're not gonna catch gold now. Hell, gold was at what, 15 trillion? Now it's at 35 trillion. Silver's at, yeah. So look at that. It's so easy to control crypto with these big institution, or do you want to call them market makers? Because there are people out there that are individuals that can be market makers as well. It's very easy to push the price around when you have such a small market cap. And this is how it works. This is why I didn't like the idea of ETFs, because it's no longer a free market. You have institutions that are kind of playing their games. The one thing you can't hang your hat on though is that if you get these bills out of the way, and with the environment we're going on, it should be risk on appetite. So you should see some nice moves in these areas of crypto. But like I said, we need the bill out of the way. That's one thing that's holding it back. And if you think about it, the institutions, the market makers, if they can get this out of the way, now they have clarity. Now they can start giving this to their customers. Now you can see a lot more funds flowing in that they would then be moving into crypto. They still have other products to control prices and stuff, unfortunately. And that's one big thing I never did like about it.
Yeah, you're not wrong. But everything you said, I think you're spot on, sir. Yeah. Markets are large. The people that are able to make those moves are the large players now. TradFi, that's what we're looking at. I think still the most interesting aspect of this to me is that up until this point, the market was pretty much operated off of pretty close to pure market psychology and a very nice deviation in the supply and demand graph whenever we had the halvening. But now it's entirely different. We've seen the fundamentals shift. So the question is, if the fundamentals have shifted, has the 4-year cycle shifted or changed or been removed entirely? I think it's a decent argument to say that even though it looks like it's the 4-year cycle now, just the factors overall controlling it are able to go beyond it. So it might still have a factor, but it's going to be a sub factor. It's not the main one, maybe not even top 3 anymore.
It's still a narrative that it hasn't been proven wrong. So that narrative is going to keep being relived. And that's why I kind of feel like the 4-year cycle didn't really get the euphoric blow off top. So people were kind of like, wait a minute, the cycle can't be over. We didn't get a euphoric top, so we should have an extenuation. Other people were holding firm, like, nope, it's 4 years. I am dumping and I'm selling, and just because it's a time-based exit strategy. Like I said, kudos to them for getting out. But once again, on the downside, are you going to get the same unnormal, we'll say, of the last? I don't think you're going to see a pullback similar to the last 3. I don't think you are.
I think it's a fair assessment.
I mean, it could, absolutely could. We're not going to have a crystal ball, but what I'm saying is, if it didn't react the way it did on the way going up, what makes you think it's going to react the same way on the way down?
I think that's a very, very valid train of logic that has not been shown enough respect, which is that we saw the action going up. Why wouldn't you see it going down? Well, 4-year cycle. 4-year cycle is not why we went up. So, yeah, makes sense. You got to have both sides of the coin, not just the shiny side. Alrighty, good sir. Any final thoughts before we get out of here for the evening?
No, I think we covered a lot of stuff. I would tell everybody who's not interested in ProofX, go take a look at it. Even for those who don't even care for it, go check it out. I mean, I think it's worth looking at. Who knows? Maybe if you guys are in other ecosystems, bring it up with other people in your other communities. Bring it up as maybe as something to look into that maybe your community can benefit from. And if that means not necessarily using ProofX, you might want to look at the technology, because it's a very fascinating technology. That I think more and more people need to be looking at that, because it solves the 2 problems. One, you got to satisfy, the government's KYC and whatnot, but at the same time, you want some privacy. This kind of solves both of those, helps out with a lot of it. So I'd say that's something to look into. Look, and of course, all the other benefits of on ramping and off ramp that would benefit anybody, certainly DeFi related. So I think people need to start looking into that.
Most definitely.
The other thing is,
we're going to be looking into that even more inside of our Telegram, which, by the way, folks, if you want more of the information here and even more of the deep dives, go ahead and join our private Telegram. You can find the link to that over at our website, walktheblockndf.com. Over there, we like to say the waters get rough, so don't sail through them alone. Come join us as we navigate digital finance together. Private mentorship, exclusive live streams, Q&As. Go from beginner to intermediate to expert with us.
Right, and then exactly. And we're going to be doing a lot of stuff in here. Like, look, we do talk about a lot of stuff. We bring a lot of the news articles that we're finding out there, bringing it to fruition. But it's also, when you have a community of people you can talk to and bounce ideas off each other, it makes it easier to not make mistakes. That's the other thing we try to do. So we are trying to build a community there, to where we're trying to be very unbiased. We don't want to try to bring anything there. We're not pushing anything. We're just trying to get us all to essentially challenge us, all of us, to challenge us to become better, to kind of, you might have a great theory. Cool. Well, here's something you may not thought about. What about this? And those are the great things we like to do. So having those discussions in there, it's been really good. We are going to start diving into some of these products like this, like ProofX, and it's understanding like when to use it. Because right now it's in beta. So I'm not telling anybody out there, don't go out there and use it. Don't, just check it out, look at it, but because it's in beta, keep that in mind. So don't use it.
Where we also say, if you do choose to try to play with it, please test transactions and sacrificial wallets, otherwise known as condom wallets, aka the ones that you're going to be putting into questionable things.
And if you don't know what that is, come join the Telegram. I'll be more than happy to explain it to you. And there's a lot to unwind there, because once you get into the world of DeFi, the technology and what's at your disposal there's no limitations.
The horizon's open.
The DeFi world. Yeah, you can do anything. You're not locked into, you have the whole world to buy any type of coins you want on any types of networks. You're not just hostage to what central exchanges are offering. And to keep this in mind, there's no way a central exchange could offer all the coins. It's just too much.
Too many.
It's not realistic. So anyhow, yeah, a lot of good conversations. We'll be diving into those stuff. So more to come there as always.
Excellent. With that being said, folks, we're always going to be keeping you guys up with the latest and greatest when it comes to the crypto news world. And you can catch a lot of that here, 8 p.m. Eastern time on Mondays, where we do our streams, which will always be free. But if you are interested in getting even more of the good stuff, and by the way, guess where we put a lot of the stuff we talked about here tonight first? That's right, inside of the Telegram. So if you want that, go ahead and join that. We would love to have you, love to hear your thoughts, and start working together. Basic philosophy is the whole iron sharpens iron, one man sharpens another thing. If we can all work together, we can all learn. So that's what we're going for. Outside of that, keeping an eye on the markets, keeping an eye on the crypto bills, seeing what's going on, and then we'll keep you updated with anything that we see along the way. Well, till we see you guys next Monday, I hope everyone has an excellent week out there. So, ladies and gentlemen, good night.